Canada's most important financial institution just laid out a risk in the Canadian financial system, one that not only could lead to uncontrolled mortgage rate increases, but also could lead to a downward sell-off spiral that could risk the government's ability to function effectively. Let's talk about how this would impact every single Canadian, their money, their investments and jobs, and how barely anybody is talking about this. The Bank of Canada released their financial stability report, and like all Canadian news, most of the attention went to the impact of the possible changes to the US-Canadian trade relationship. But I believe that this headline is playing cover for a bigger risk, one that the government and the Bank of Canada have very little control over. You see, in the report, they warned that massive hedge funds have been making speculative investments. That's not new. Hedge funds make bets all the time to make money. What's different now is that instead of betting on stocks, they're speculating on Canadian government debt. And they're doing so by becoming massively important players in the Canadian bond market. Now that might sound complex, but trust me, it really isn't. Here's a quick explainer and it will serve as a refresher if you're already familiar with what I'm talking about, but I promise this will get you up to speed so that you can understand how all of this could majorly impact Canada's economy. The government of Canada, not unlike other countries around the world, doesn't make enough money from tax revenue to operate all of the programs that it operates. As a result, it often ends up needing to go into debt. Now, when it goes into debt, it does so by creating and selling something called Government of Canada bonds. You can think of these bonds as an IOU. They'll sell this IOU to a buyer and they'll say, well, at the end of the term, let's say it's 1 year, we'll give you your $100 that you paid for this IOU back, but we'll also pay you an additional interest rate, in this case 5%. So the buyers are saying, okay, I trust the government of Canada to pay me back my money plus this additional interest rate that I can earn, so I'm going to buy this government bond or this IOU. Now, these IOUs or bonds are really interesting because the interest rate here will influence the rates that average Canadians like you and me will pay on things like mortgages or car loans, and it's also going to impact the rates that businesses will pay on business loans that they may take on to expand their operations. All this to say, these things, well, they're really important. And there's something unique about them because they have a really cool supply and demand balancer. You see, if the government needs to borrow more money, well, it will create more of these IOU bonds for people to buy. That increases the supply of these bonds. But if there aren't enough interested buyers for the increased supply, both the price of the bonds and the interest rates, well, those will change. If there aren't enough buyers, the price of the bond will go down, but at the same time, the interest rate that the government pays on these bonds will go up, which will incentivize more buyers to be interested in buying it. If you're not going to borrow or lend money at 5%, well, maybe you would have a change of heart if we increase this interest rate to 10%, better prospects for these buyers. And it also works in reverse. If the government doesn't issue so many bonds, but there are tons of buyers who want them, well, the price here will go up and the interest rate that the government pays on them will go down. But what happens if all of a sudden the government needs money, needs a lot of it, and needs it fast? Well, they create way more bonds than ever before, so much so that there just aren't enough buyers with enough money who are willing to buy the bonds, even at higher interest rates. Well, what happens then? Well, it can lead to some major problems for the Canadian economy, the federal government, and for average Canadians who are trying to buy a house, who have a variable rate mortgage, or who might be trying to expand their business. We found ourselves in this situation in recent years, and it all ties into the major risk that the Bank of Canada just outlined. We're going to take a look, but first I want to thank the sponsor of today's video, and that is Clutch. If you've ever tried selling your car, you're probably familiar with how frustrating it can be, wasting hours of your life dealing with flaky buyers or haggling at a dealership. Instead, use Clutch, the fastest and easiest way to sell your car in Canada. In just 1 minute, you can get a real instant offer at clutch.ca. It's not some sort of fake estimate or lowball offer. What you see is what you get. No haggling and no pressure. And once you get that offer, you can schedule your sale online in under 30 seconds. Then either drop it off at a nearby Clutch location or have it picked up right from your home. No need to clean the car, take photos, or deal with marketplace headaches. And the best part is that you get paid instantly. You don't have to wait for checks to clear or e-transfers to come through. The money is wired straight to your bank account on the spot. And if it's important to you, you can go from car to cash in under 24 hours if you're trying to move quickly. People love Clutch because it's easy, honest, and online. No strangers, no meetups, and no hassles. And Clutch is currently available in Ontario, BC, and the Maritime provinces. So whether you're just curious what your car is worth, or if you're ready to sell today, use the link in the description or scan the QR code on your screen to get a real offer in just 1 minute. During the pandemic, the Government of Canada took on massive debt in an effort to keep the economy afloat. Now, we can discuss how effective this was and if it was worth it, but that's for a different video. Now, as a result, they created $300 billion worth of new Government of Canada bonds. At the same time, buyers are like, that's a lot of money, and we're not really willing to pay it, especially because of this whole COVID thing. We don't know where it's going to go, so we're just gonna not buy these and we're going to hold on to our cash. That means that the Government of Canada wouldn't be able to access the money it wants, while at the same time, interest rates could shoot up dramatically for average Canadians, making the horrible economic situation caused by COVID even worse by creating dysfunction in the bond market. But don't worry, here comes the Bank of Canada. We will step in and buy as many bonds as you want. We recognize that a dysfunctional bond market, it's not good for our financial system. So we'll buy up all of these bonds and keep interest rates low so that businesses can expand, Canadians can load up on cheap mortgage debt, and hopefully, as a result, we'll be able to get through the pandemic. For right now, we'll gloss over how the Bank of Canada essentially created money out of thin air to buy these bonds, leading to higher inflation both in goods and services and in asset prices like stocks and real estate, but that is a big element here, even though we're not going to cover it entirely today. So the Bank of Canada bought up around $430 billion worth of bonds during this period. But in response to the incredibly high inflation Canadian consumers were experiencing, they thought, whoa, Nelly, we gotta slow this train down. And they stopped buying bonds. Instead, they slowly started letting them expire and roll off their balance sheet. The only problem is the Canadian government doesn't have the money to pay off their debt when it comes due. Just like a mortgage, at the end of 5 years, you need to get a new mortgage that pays off the old one. That's what the Government of Canada does each year. It creates new IOUs or issues new bonds to pay off the old ones. But now the Bank of Canada is only continuing to hold about $200 billion worth of bonds. So the difference between the peak here and the bottom is about $230 billion worth of debt that needs to be refinanced. But now the government or the Bank of Canada isn't that buyer, so who will be? So the Bank of Canada is out, and remember, if we don't have enough buyers, that can lead to dramatic interest rate spikes and the breaking down of the government debt bond market. Not good. So with the Bank of Canada out and not enough buyers, well, what happened and why haven't we seen this economic breakdown that I'm talking about? Well, in come the hedge funds. They're trying to make massive profits with a special type of trade. Now, I'll oversimplify it so it doesn't take all day, but basically they realized that they could make a small profit by buying government bonds today and at the same time using a special strategy to lock in a slightly higher price to sell them at later. Now, this gap between today's price and the future selling price is where their profit comes from. This is called the futures basis trade. But if that gap moves in the wrong direction, everything can fall apart, which is exactly what the Bank of Canada is warning about, which could impact average Canadians dramatically. We'll get into that in just a second. But hedge funds aren't in the game to make small profits. They want to make serious money. So they borrowed billions of dollars to do this trade over and over and over again at a far larger scale than if they were only using the cash they actually had on hand to do so. In the report that the Bank of Canada just put out, they revealed that this debt-fueled hedge fund basis trade has led to hedge funds buying up nearly half of all of these refinanced government debt bonds. This has the potential to lead to some big problems. If all of a sudden this trade that they're making loses its profitability and there's nobody left to buy the government debt, well then what happens? Here's Senior Deputy Governor of the Bank of Canada, Carolyn Rogers, talking about this exact risk.
In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system.
The key takeaway here is that if there's an unexpected shock in the market, be it from a big change in trade policy or some other financial black swan event that we don't expect, well, hedge funds might start selling all of these bonds that they hold. And hey, they're free to do whatever they wish, but selling these bonds will cause their prices to go lower, supply and demand. That could be a big problem because of how much these funds have borrowed to buy these bonds. If the value of the fund's assets go down, and those assets are used as collateral or backup for the loans that they've taken out, they could be forced to sell these bonds in order to pay back their loans. Now, this would lead to prices going even lower and more funds finding themselves in the same situation. You can see how this could turn into a downward spiral of cascading loan repayment calls, otherwise known as liquidations. And as the hedge funds leave the bond market, well, who then will buy all of this government debt? The Bank of Canada isn't buying anymore, and now hedge funds are out, and the original buyers likely don't have enough cash on hand to absorb all of this forced bond selling. Well, with so much supply and so little demand, interest rates on these bonds, and as a result, on mortgages, on car loans, on business loans, and all other types of credit could go through the roof if nobody else intervenes. So the Bank of Canada warns that it's incredibly important that these hedge funds prepare for this rainy day, have extra cash on hand, otherwise we could see this worst case scenario play out. So what exactly is the Bank of Canada doing to prevent all of this?
What tools are available to persuade hedge funds to heed your message on liquidity?
I mean, one of the primary tools is the report itself and bringing some transparency to the risks that we see. Because what you don't want to have happen is whatever risk strategy one sector has to manage volatility depends on another sector doing something or not doing something, and it turns out we're all storming for the doors at the same time. We're all looking for liquidity at the same time. So we're not a regulatory body. We work closely with other regulatory bodies across both domestically and internationally. But it's not necessarily our role to bring regulation. And quite honestly, not every problem requires regulation to fix it. Sometimes the transparency is enough.
Since the Bank of Canada isn't a hedge fund regulator, they can't really force the funds to do anything. They say that just by releasing this report, they hope that hedge funds will do the right thing and keep idle cash on hand for this rainy day. But can we really trust these major funds to do so? When it comes to something so incredibly important for average Canadians and the interest rates they pay, especially given the huge amount of household debt we find ourselves in on average, can we trust them to do the right thing? I'm not entirely sure. The Bank of Canada was also questioned about the role that it played in increasing how vulnerable we are to the risk of higher interest rates by contributing to higher household indebtedness when they massively intervened buying $400 billion worth of government debt when nobody else would, keeping interest rates low while incentivizing individuals and businesses to take on tons of debt with the expectation that rates would be low for a long time.
How much responsibility does the Bank of Canada ascribe to itself when it comes to the rise in household balance sheet vulnerabilities in the last decades?
Look, household indebtedness has risen now, going back, a large number of years. I'd have to actually go back to put a number on it, but we've been expressing concern about rising household indebtedness for many years now. And that's happened against the background of low interest rates. It's happened against the background of high interest rates. So I think it's a broader issue than monetary policy.
So he says, well, household indebtedness has been a problem for years, so it's not just monetary policy, it's not just our fault. And while, of course, this issue isn't only because of what happened in the past 5 years, it's hard to act like it didn't have an impact both on the debt that Canadians hold and their ability to afford things like housing. And if we do see this mass exit of hedge funds from the bond market, well, my guess is that the Bank of Canada would once again step in as the buyer of last resort for this government debt. The only problem is this could once again repeat the cycle of propping up assets like stocks and real estate while increasing the cost of living for average Canadians. I think that this would further widen the wealth gap between those who own assets and those who only save dollars or are paycheck to paycheck. Which leads me to this final clip. A reporter asks for comments on how President Trump has threatened to fire the head of America's central bank, the Federal Reserve, but I think it gets at a point deeper than that I find incredibly interesting.
Well, look, the independence of the central bank is sacrosanct. I mean, it is a key element of central banks around the world. There's a reason you have independent central banks, and the record of independent central banks with clear mandates, in our case, an inflation target, has served Canadians very well, and similarly in other countries. So I don't think you want to threaten the independence of the central bank.
Here's something that you can look into further if you're interested. After World War II, with support from the Bank of International Settlements, which is sort of the bank for central banks, banks like the Bank of Canada became independent from the government. This meant that politicians couldn't interfere with monetary policy. That's good in some senses because it stops short-sighted politicians from messing with interest rates and money printing directly. But it also removes any kind of democratic and, in many cases, legal accountability that the central banks might face. They're supposed to be serving the interests of citizens of their country. But what happens when they make a mistake that harms the quality of life for average people? Or even worse, what happens if they become influenced by personal political ideologies or relationships with corporate interests? There's not really any recourse. There's nothing we can do about it. This is a lot of power to put in the hands of a centralized community of bankers. In some ways, they hold more influence than any prime minister or president, yet they can't be voted out. At the same time, they're asking us to trust that they'll always act with our best interests at heart. The problem is, this trust is getting lower, and I don't think that diminishment of trust is without good reason. So what do you think of all of this? What do you think of the thought of the hedge funds having a bigger and bigger role in Canada's bond market and the risks that poses if they all of a sudden leave or head to the exit at the same time, like the deputy governor said? And what do you think about this broader idea of how much control central banks have over the economy of the world? Is this the best solution that we have, or are there tweaks that could be made? I'm not certain myself, but let me know what you think. What have I gotten right? What have I gotten wrong? I'm trying to figure out all of this stuff just like you are. And if you want to see the sources for this video, you can sign up for the email newsletter where I send out the sources for every single video. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.